Welcome to Growth Investing Mastery. This video will look at growth stock value, or how to value a growth stock. As a reminder, this is not investment advice or recommendations to buy any stocks. Valuing a growth stock is a tricky subject for many growth investors. The topic often leaves growth investors wondering if they should use value at all. In this video, we will look to demystify the process with a comprehensive valuation framework. We'll also discuss valuation in a crashing market and the implications there. Let's step back for a moment and discuss the definition of value. Value has many definitions, and the term can be used as a noun or a verb. In Latin, the word value means be worth. And the verb definitions for valuing something include estimating the monetary worth of something and also considering something to be important, beneficial, or having a high opinion of. These two definitions correspond well to our numbers and narrative approach. We want the monetary worth of the company to be high, and we want the story or product to be important, to be the next big idea, and have a promising future. The numbers side corresponds to price to earnings ratio, price to sales ratio, and growth rates, while the narrative side corresponds more to industry comparison and subjective prospects of the business. One aspect of the definition I found interesting is on the monetary value side, it says estimate. So we don't have a precise value because people may be willing to pay different prices. And we can think of the market as constantly trying to estimate the value of a stock. Our investing edge lies in estimating better than the market. And something being important will always be a subjective take. For example, one company we're invested in is called Electrovaya, and they're a next generation battery maker. But what should this company be worth? That's going to depend a lot if we think batteries are basic and unimportant, or if we see important innovations with the product. If we think the batteries are just a commodity, or if this is the next big idea, is going to make a big difference in how we view this company. Let's now discuss what we should measure in evaluating a growth stock. Our goal is simple. We want to find companies accelerating sales and profitability. We use revenue as a primary financial metric, which has the same definition as sales. But profitability has dozens of different types of metrics to choose from. In our system, we use solely net income and EBITDA as our metrics of profitability. These are two complementary bottom line metrics that are impossible to fake together. And what we mean by fake is sometimes companies can have a one-time tax benefit benefiting net income, or the company can change their depreciation schedule, impacting EBITDA, but they can't fake both. The best part of using these two metrics together is they work across various industries, including ones with high capex or depreciation of assets. This means we don't have to change our framework if we're looking at a different industry than we usually look at. Using just these two metrics simplifies the approach greatly. It means we don't get lost in the mix or get cognitive overload on all the different possible profitability metrics that we could look at. The question often comes up, should we use GAAP or non-GAAP, sometimes called adjusted metrics? And the most important point on this topic is we always want to make apples to apples comparisons. This means if we're looking at Q1 versus Q2 of a company, we want to compare either GAAP to GAAP or adjusted to adjusted. And the same goes comparing companies in the same industry. If we're comparing two separate companies, we want to look at adjusted versus adjusted numbers, for example. Usually the adjusted numbers take out stock-based comp, and if we trust management, we should use those numbers. But it's also good to look at the GAAP numbers as well. We want to see if a company is egregiously paying out stock-based comp, and that might be a potential issue. Another question that often comes up with price to earnings or price to sales is, should we use the trailing 12 months, the run rate, or the forward looking 12 months? Almost all data providers for price to earnings ratio provide a trailing 12 months ratio. However, for many growth stocks, what happened 9 or 12 months ago is ancient history. A company that is growing really fast can have dramatically different earnings from about a year ago. For this reason, we prefer the run rate for price to earnings and price to sales. This gives us the best view of what the company is capable of doing right now. We also try and avoid forward looking metrics as much as possible. Forward looking metrics are based on analyst estimates, where the analysts often just pencil in the next number. There's usually not a lot of thought that goes into those analyst estimates. Additionally, any forward looking metrics depend on predicting the future, which we don't want to do. One last question that often comes up is, why not use cash flows? And our viewpoint is, a lot of investors talk about cash flows when they want to sound smart. But cash flows heavily penalize a growing business that is reinvesting, because cash flows count CapEx and OpEx against the cash flows. Here's an example. There's a company that's expanding factory capacity and hiring lots of new employees. The expanding factory capacity increases their CapEx, counting against their cash flows. And the hiring of the new employees counts against their OpEx, also hurting their cash flows. Additionally, accounts receivables are part of the cash flow calculations. And sometimes contracts get delayed payments, and this will also impact the cash flows. But at the end of the day, we don't really care if the company collected payment in this quarter or it missed by a week. Our end goal is to be able to evaluate a business quickly and effectively using revenue, net income, and EBITDA. Knowing these three financials, the industry, and the product, we should be able to get a ballpark estimate of the value for this company. Let's now look at what financials the greatest of all time investors cared about. In our system, the two goats of growth investing are Saul and Philip Fisher. Philip Fisher's Common Stocks and Uncommon Profits is a part of our study corpus. Yet both of these investors had different primary considerations when evaluating a growth stock. Saul primarily looked for top line revenue growth, while Fisher looked for bottom line earnings growth. And one key takeaway after studying both of these investors' works is that investors are a product of their investing time. When Philip Fisher was at the height of his fame in the 1950s and 60s, he had no exposure to companies that were expanding through sales only and not getting earnings. We can think of the example of Amazon in the late 2000s. Can they monetize? Was the mantra by the financial media. And there was a lot of fuss made around that Amazon's not getting any profits. They're losing money every quarter. So, how much could this business really be worth if they can't make a profit? It's obvious to see now that critique of Amazon was invalid. The company was able to grow sales without getting earnings, but over time, the company became extremely profitable. And when Saul was investing in the late 2010s, there was a market that respected top line growth primarily. The market at that time found top line growth more important than bottom line growth. One key takeaway here is we can have the best of both approaches. And we prefer companies that are growing both the top and the bottom line. And we like to use simple metrics for measuring the value of both of these top and bottom lines. The price to sales ratio covers the top line, and the price to earnings ratio covers the bottom line. We would like to see our companies show up well on these ratios and be accelerating in revenues and earnings. This is keeping in mind we need to balance the growth rates with the prospects for the company. One key takeaway here is that companies with high price to sales ratios can still be undervalued if the growth is large. And there's a common mistake in assuming a company which has a high price to sales is automatically overvalued. Another key insight is that sometimes the market values the top line growth more, and other times it values bottom line growth or earnings more. Let's now take a look at an analogy we like for evaluating a growth stock. Rare toned coins present a similar proposition to evaluating a growth stock. The toning on a coin can increase its value quite a lot, but it depends how strong the tone is. Some toning may double the value of a coin, while other toning may make the coin worth as much as 10x the book value. And normal coins without any toning are a lot easier to value. You can look up the condition of the coin and see what the book price is. And I put some examples over here on the side where we show a low to mid grade toning, a mid to high grade toning, and what's called monster toning. So the low toning may increase the value of a coin a little bit, but the monster toning will increase its value quite a lot. Rainbow toning on a coin is rare and it happens over time. The value of the rainbow coin is in the eye of the beholder. Yet the market will pay a premium for these types of coins, but the range widens quite a lot. And a coin purchaser needs to be careful with uncertified or ungraded rainbows for fake coins or fake toning. In the stock analogy, some companies are growing through acquisition, or they're growing by taking on debt, and these aren't the types of companies we want. We can think of the revenue and profitability pattern of a stock over the past year as similar to the toning of a coin. A growth stock may have a growth rate that is unparalleled in the marketplace within their industry. And this makes it much harder to find an exact book value for what we should pay for the stock. For example, Astera Labs is a semiconductor that's growing revenue 104% year over year and 20% quarter over quarter. The company has unusually high gross margins, over 75%, and they're already profitable. In the analogy, Astera Labs is showing monster toning, and we want to pay up for monster toning. The only comparable company in the industry is Credo, with similar high growth rates. Both companies are valued around roughly $30 billion. A question that may come up is, can both companies be overvalued? And that is a possibility that both companies can be overvalued. But we can also use that industry comparison to see when one of the companies gets out of whack, and we'll talk more about industry comparison coming up. Another example for the analogy is the semiconductor Nova. They're a growing company, but growing at a slower rate than Astera Labs or Credo. Recently, they had a 40% growth rate for revenue. In the analogy, they would have a medium amount of toning, so we'd still pay a premium, but not as much. A key takeaway is that valuing a growth stock is more challenging than valuing a value stock. Now let's discuss our key evaluation methods for valuing a growth stock. We use 5 primary methods to evaluate a company on. We can think of this as similar to a toolbox that a handyman may select from. And the methods are a mix of objective and subjective ways to evaluate a company. The first is the price to sales ratio, which measures the top line. The second is the price to earnings ratio, which measures the bottom line. We also use an industry comparison to see how the company stacks up against its peers. The fourth method is relative price, or where the stock price has been recently. And the fifth category is completely subjective. We call it seems like. So we may say a company seems like it's overvalued, or it seems like it's undervalued. Getting into some more details of how these methods work. Price to sales is a completely objective measure of revenue or sales versus the market cap. In a similar way, price to earnings is a completely objective measure of the earnings or the profitability of the company versus its market cap. The industry comparison is looking at competitors and peers to see how the company lines up, especially if it's a newer industry we're not that familiar with. We'd like to see the price comparisons between competitors and what their PS or PE ratios are. The relative price is a basic approach to look at where the stock has been recently, and the more recent the data, the more relevant. The seems like category is a broad catch all category for subjective analysis. For any company we are evaluating, we want to see how the company shows up on these 5 different evaluation methods. We want to look for where a company really stands out, whether it's good or bad. So sometimes a company may have a really high PS ratio or a really low PS ratio that's way outside of the bounds that we expected. Our analysis may show a heavily undervalued stock, which presents a big opportunity. On the other hand, a company being overvalued may mean we trim it or start a smaller starter position if we're new to the company. Let's now dive deeper on price to earnings ratios. Price to earnings is the most traditional way to value a stock. And before the year 2000, this was the gold standard to use across industries. However, many companies now scale up before becoming profitable. What this means is that many fast growing companies have no earnings or they have negative earnings. And the bottom part of the PE equation then becomes undefined, meaning it has no meaning. So in this case, we cannot do PE-based analysis. Although we do want to check how the company shows up on profitability, even if there is no price to earnings ratio. For example, a company with negative 5 million of net income is better than a company with negative 40 million of net income, with all else being equal. We want to use caution on evaluating a company with PE that just turned profitable. This is because a company that just turned profitable will have a really high price to earnings ratio. And the PE ratio is best used for companies that have been profitable for 1 to 2 years at least. Companies in industries that are more mature tend to have PE ratios. And this price to earnings analysis works well in older industries that may have a new industry tailwind now. One example is from 2023, where Supermicro had a trailing PE of 6 with growing revenue and profitability. And just continuing the revenue growth rate and increasing profitability would make it even cheaper. In this case, there was an opportunity to capture the value while still delivering the growth. And the AI tailwind for this company had already started, but the market was slow to appreciate the opportunity. A question often comes up, but what about efficient markets? And efficient markets only really matter if all the participants are knowledgeable about what's going on. And the vast majority of market participants in 2023 did not know or understand the AI tailwind just yet. Let's get into some examples of how price to sales works. The metric price to sales gained a lot of popularity during the SaaS boom of the 2010s. Many of these SaaS companies were scaling up without being profitable. Oftentimes, these companies were spending over 100% of revenue on sales and marketing. To an outside observer, that might seem like a disastrous business choice. However, many of these SaaS companies recognize the value in becoming ubiquitous or capturing market share, and they had a land and expand program. This type of business model was unthinkable just a decade prior. Initially, market prices for these stocks failed to recognize the company prospects, creating a huge opportunity for growth investors. And the recurring revenue model with SaaS was different than a traditional business that sells one-time purchases. The PS ratio was needed to evaluate these SaaS companies because the traditional PE metric was useless with no earnings. And the market began to lean in more to using the sales versus market cap as a way to measure value. This was different than the traditional way to measure value, which used to always depend on earnings. Something to keep in mind is that PS ratios will vary dramatically based on the industry. So we expect to see higher PS ratios for industries like software. And sometimes the industry itself will go through a boom or bust cycle on valuations relative to PS ratios. One example I learned about recently was in 2020, cannabis companies saw PS ratios of about 50. But now all the hype is gone from that industry, and the typical PS ratios there are often below 5 or even lower. Another thing to keep in mind when evaluating on price to sales ratios is we still want to see companies moving towards profitability. And it's important to look at the bottom line metrics as well to see improvements as the company scales up on sales. Diving into industry comparison examples. Each company we look at should be evaluated compared to its peers and its competitors. We can look up which companies are direct competitors or if there's any similar companies out there. But sometimes we really do have a company that's completely unique. Even in this case of a company that has no direct competitors, we should still look to compare on general industry categories. One example to demonstrate how industry comparison works is between two SaaS companies. And the two we're looking at for this example are Paymentus and Figma. On the surface, the companies present similar financials in the same industry. Comparing how these two companies stack up, Paymentus had revenue of 311 million, which is up 34% year over year. They had EBITDA of 30 million and net income of 18 million. Figma, on the other hand, had revenue of 250 million in a recent quarter, which was up 40% year over year, EBITDA of 5.7 million, and net income of 52.5 million. And we can see these companies look pretty similar on financials. Paymentus has a little bit more net revenue with a lower growth rate. And Paymentus had higher EBITDA than Figma, while it had lower net income than Figma. And I think Figma did benefit from a one-time tax benefit on that net income, but roughly these are similar financials here. And both companies are in the same software industry with a SaaS business model that's selling to enterprises. Yet the market cap for Paymentus was 4.7 billion, and Figma's a $22 billion company. And Figma actually debuted as a much higher market cap, closer to 50 billion, before some of that value came out of the stock. So, since these companies have similar financials, it's clear the market views Figma's narrative or story as having much higher value than Paymentus, by 5 to 10 times as much. And the market prices may be based on the participants' analysis of the total addressable markets, the market sentiment, or even hype around the stocks. Something else to keep in mind is that Paymentus is a much lesser known company and lesser promoted by investment banks, which may be a factor in the stock price. And I left two open questions here. Does this guarantee that Figma is overvalued? Or does it guarantee that Paymentus is undervalued? And the answer to those is no to both. But it is a good sign that Paymentus could be undervalued, and maybe Figma has too much hype right now. On the other hand, maybe Figma's story is strong enough that it really warrants this much higher value compared to its peers. Now let's discuss the concept of relative price. We can think of relative price as where the stock was recently. A key caveat here is we need to balance this approach with what the recent news is on the stock. Here's two much different scenarios. Stock A lost 50% of its share price on general market concerns, with no bad news for the specific stock. But stock B lost 50% of its value as a key customer switched to a competitor. So in this case, the stock A that went down on no news is showing up pretty well on relative price. But stock B actually had some really bad news, so maybe the 50% sell-off actually is warranted. Let's take a look at some examples with some top holdings. In February 2025, AppLovin had a strong earnings report and saw the share price go all the way up to $500.15. But about 1 month later, around March 7th, the stock was down to $234, or over a 55% stock price drop on basically no news. And the drop did coincide with a general drop in the market, but the NASDAQ didn't go down 55%. Looking at another example, in January of 2025, Astera Labs saw the share price overextend to $147 a share. But by April 2025, the share price touched all the way down to $47 a share, a 68% decrease. There was the DeepSeek algorithm release impacting the share price, additionally followed by tariff concerns. The open question here is, should these fears have caused the stock to drop 68%? The answer to that is almost certainly no, as it's unlikely the business would have lost 2/3 of its value. However, we did mention it overextended on the price in the first place. So some correction was natural, but this seems like an overreaction to us. Additionally, there was no direct business news that the company was seeing a slowdown. And that's a key factor because maybe the 68% drop would be warranted if the company had lowered guidance. But the end result was that Astera actually was showing up well on relative value. And in September 2025, the stock hit $263 a share. But the boom bust swings of the market continue for Astera Labs. As of November 2025, the stock is back to $140 a share. You'll often see in emerging industries or new companies that are growing fast, the market has trouble figuring out the price. The collective market participants will become way over optimistic, but then they'll be too fearful a short while later. One key takeaway is we will not be able to time these swings easily, and a lot of these swings look obvious from historical charts. And it's easy to start believing the fear when your stock is crashing. Maybe the other participants know something. So we need to use mental game strategies to help dissipate some of this fear, which we talk about in other videos. Our last key takeaway here is that relative price plays a large role in our adding and trimming decisions. If a stock is showing up really well in relative price, we may want to add to it. But if the price is getting way overextended or way out of whack, then we may want to trim that position some because it's getting overvalued. Let's take a look at the last category we evaluate a growth stock on, which is called seems like. We use this catch-all category for subjective analysis. Sometimes a company valuation just seems like it's too low. And it can be frustrating for numbers-based investors to accept that this is part of the game. A lot of numbers-only investors want there to be an algorithm, but subjective analysis cannot be done that way. Here's a few examples of how this subjective analysis is done. A few months ago, the company Iron had a $5 billion valuation, and they mentioned one of their facilities will hold up to $70 billion of AI infrastructure. And it just seemed like if this company can actually get up to $70 billion of AI infrastructure, then it should be worth a whole lot more than $5 billion. Another example that's top of mind dates back about 6 years ago. And this is when Cloudflare debuted as an IPO, and the valuation was priced at $5 billion. But Cloudflare was often said to be running the internet, and when Cloudflare would go down, many websites would crash. It just seemed like a company that was running the internet should be worth a whole lot more. This seems like type analysis can run the other way too, and we can often find companies which are overvalued. There's a good example from 2020 when Snowflake went public. The company started off with an $80 billion valuation, but they only had 120 million of quarterly revenue. And while Snowflake had a really compelling narrative and promising numbers, it just seemed like $80 billion was a lot to pay for a company getting this little revenue. And something to keep in mind with the stock market is lots of pre revenue companies can have really big valuations. So we may see a stock that has no revenue or maybe 5 million of revenue, but it's worth over $5 billion. The valuation for these types of stocks purely comes from their story or projections alone. And this is where the name story stock comes from, because most of their value comes from the narrative. And I left an open question here. Can a story stock do well? And the answer is definitely yes. But its probability of doing well is lower than a company which has a compelling story and is also backed by strong financials. One key takeaway is that it seems like type analysis works really well when we find something that's a magnitude off in value. For example, when we were thinking about Cloudflare going public, we envisioned them as a $50 billion company, only to find out their value was projected at $5 billion. Now let's discuss how much is the growth worth, or how much should we be willing to pay for a growth stock? Mainstream financial models for growth stocks have no way to model higher growth properly, and AI models are completely clueless how to solve for this. So that's good news for us as individual investors that AI hasn't figured this out yet. And once we get above 40% year over year revenue growth rate for companies, they're in a class of their own. These companies will have few peers, except if they're in a booming industry like AI right now. Something important to keep in mind is that we'll have to pay up for higher growth names. Yet many growth investors refuse to pay up, hoping for bargains. But usually when that bargain arrives, there will still be excuses for not purchasing. The challenge is in knowing how much to pay up because of the multitude of critical factors. Industry growth and the subjective aspect of the narrative are two that often trip up growth investors. We should pay more for an industry that has a tailwind, and two examples are SaaS in 2015 or semiconductors today in 2025. We can also look at the opposite of that, where buying semiconductors indiscriminately in 2015 was a losing strategy, or at least not a great strategy. And buying every SaaS stock in 2025 is unlikely to be a winning strategy as well. When we're figuring out how much to pay up, the narrative or the story the company is telling is important to figure out the value. Often this includes items such as the company having revenue visibility into the future. In our analysis, we must include aspects of the business model, such as preferring a recurring revenue stream. And we should be paying up for innovation, strong business models, and industry tailwinds. Our next topic is if we should ever sell on valuation alone. One key insight for our strategy is we never completely sell a stock based on valuation alone. This also assumes the business is still overperforming. And if we own a stock where the price runs away to the upside, our strategy is to trim that stock. We can trim more aggressively as the stock price gets more out of line. A natural question that may come up is why not just sell now and buy back lower? The logical flaw there is assuming hindsight bias. So when we look at a historical graph, it's easy to see we should have sold at the top and bought back later. But we don't have knowledge of the future, so that strategy won't work. Something to keep in mind is that a company doing well follows the law of inertia. And it's common that more positive announcements follow the business momentum. On the other side, a company that reports bad news often continues to report additional bad news. Something Saul said was there is no limit to how high a stock can go. Another factor is that momentum traders will often keep bidding up a stock that's rising. Complementary to our trimming strategy is our adding strategy. As a company's valuation becomes more attractive, we often add to that stock. But we need to have caution not to add on bad news or the business worsening. It's easier to add to higher confidence positions when they go down on no news. But for a lower confidence position, we may want to hold off on adding to them as we learn more about the business. It's also important to keep in mind that companies only update their main financials once every 3 months during the earnings season. Earnings is often a good time to add or trim to our companies. These new financials that the companies are reporting also give us new information to determine the fair value of the stock. Now let's discuss getting good value after a poor earnings report. A common question that can come up is what about holding a company that had a poor report, but now it becomes a much better value? Oftentimes, a growth company will crater more than we think it should have. For example, we may own a stock and it doesn't have a great report. We think it should be down about 20%, but when we check the price, it's down 40%. It may be tempting to think, let's just hold this stock and keep the value. This type of situation can present some of the most tricky scenarios imaginable for growth investors. We'll use a poker analogy here with pot odds. And let's say we're playing a poker hand and the pot is $1,000 on the river. The opponent bets $100 and we're getting 10 to 1 odds on the call. It seems like the opponent is enticing us with the low price, but it also seems like he has us beat. However, we only need to be right 1 in 10 times with the odds for us to break even. And in this hand, we might be thinking, could they really bluff here like this? Let's look at some real-world examples of where this happened recently. We owned the company Powerfleet, which reported results way below our expectations, but the price is already super cheap for a SaaS stock. The run rate price to sales ratio is below 2, while faster growing competitors such as Samsara trade for over 15 on price to sales. However, the growth for Powerfleet simply wasn't there, so we decided to sell even though we still think it's probably a good value. In our second example, Transmedics reported a huge miss on revenue numbers, and management seems confused. The stock dropped about 45%, which feels like an overreaction. We thought maybe the stock should have dropped 30%. However, the growth criteria we look for is simply not here, and we've lost our enthusiasm for this stock, so we end up selling. In our third example, Paymentus has been telling investors they are onboarding larger and larger customers, which should be boosting revenue growth. Yet the weak guidance they gave implies a slowdown in the growth rate. Maybe we had a misunderstanding, or maybe management was hyping how many customers they were adding. This presented a really tricky scenario for us. We are on the fence on selling because the value is incredible when we look at industry comparison. Ultimately, we decided to sell here and reallocate to companies we're more enthusiastic about. Next, let's check out valuing a new industry. One key insight is that the market has trouble pricing new industries. We can think of the 2000s internet bubble, where valuations got incredibly out of line before crashing down. And in our current market scenario, the market is having trouble pricing AI companies. A lot of pundits are calling for a bubble and comparing it to the 2000s internet. Yet many companies in the sector keep delivering strong results, like NVIDIA or Astera Labs. This seemingly contradictory information makes it challenging for market participants to figure out the value for a stock. Analysts often try and draw historical comparisons, but they fall short because every moment is unique. One bit of advice we'll give is to stop trying to categorize or predict what's going to happen next. We want to let the company results dictate our next actions. Yet many growth investors focus in on predicting the future. Having a know it all attitude will hurt our returns, and a beginner mindset is best. But we still want to be curious and use our imagination to understand more about the new industry. Likewise, we should use our imagination to understand what the potential downside is for this new industry. Here's a recent example of learning about a new industry. We started research on a company called Skywater Technologies, a semiconductor, and we learned they have something called quantum revenue. So, this company is actually getting revenue from quantum computing companies, but we thought this concept was still years off from materializing. From reading through the latest Skywater transcript, we learned that quantum computing is materializing in a big way. The company is getting actual revenue from companies that are building quantum based chips. Yet most of the market is still completely unaware this is a revenue generating segment and not just hype now. One last key insight here is we'd rather be wrong and find out now. We don't want to get FOMO sitting on the sidelines and saying, we knew it would happen, but we just didn't invest. Let's talk about valuation in a crashing market. We decided to add this slide because the recent market downturn often shifts our attention to the crashing stock prices, and in turn, this changes their valuations. Downturns or crashes often happen suddenly, catching us off guard. If we aren't careful, we may be in a state of overconfidence when the crash begins. This is because the stock prices of the companies we own were rising faster than we expected, and we're getting better results than we expected. It's normal to feel fear in this scenario, yet most of the common wisdom says to toughen up or steel yourself, or just renounce money altogether. In our system, emotion equals the signal to investigate more, and the stronger the emotion, or the more fear we are feeling, indicates how strong the signal is. And we may investigate by asking questions similar to these. Are we in our best holdings? Are we diversified enough? Have our companies delivered strong quarterly results the last quarter? And as we look at each business we own, are we still enthusiastic about this specific business? It's a common pattern that growth stocks rising too fast often leads to a sharp correction at some point. We can regain some confidence by confirming that we're in companies that are delivering strong results. But we may need to wait till the next quarterly report to confirm the companies are on track. And sometimes waiting those few months till the company reports next can feel like forever when the stock price is crashing every day. But what if our companies are actually impacted by the economic downturn or the changes in the macro environment? We may want to switch to a new company that's thriving in the new bear market or the recession. One key insight is that a company which can thrive in the bear market will rocket back later. A company growing in poor market conditions will do even better as the economy recovers. And the depressed stock price acts as a coiled spring, assuming the business is getting results. A common question that may come up is what if we don't have any free cash to take advantage of the lower valuations now? Our strategy stays fully invested, so we basically never have any free cash unless we sell a stock. Often all of our stocks going down make the choice of what to cut quite challenging. But it's still prudent to take advantage of anomalies, as some of our stocks may get hit harder than others. Now let's discuss what our final end goal is for valuation and that's to build a sense of intuition for how much a growth company is worth. To get this sense of intuition, it takes a lot of reps looking at different companies in different industries. We want to be able to use a limited set of data to determine a reasonable range for the valuation of the company we are looking at. We have three examples here. In the first, we have a software SaaS business. They have revenue of 400 million, which is up 30% year over year. EBITDA is negative 15 million and net income is negative 25 million. But we know it's common for SaaS businesses at this scale to still be unprofitable. So that's not really too big of a warning sign for us. And we estimate the range of the value for this business to be quite wide, from 7 billion to 25 billion. And we want to look out if a business falls well outside of this range. So if we saw a SaaS business with these metrics, but the market cap was just 3 billion, that might be pretty interesting because it's possible this company is undervalued. Likewise, if we saw the same business and the valuation was 80 billion, we'd want to find out why investors are so excited about this idea, or the company may just be way overvalued. In example 2, we have a consumer finance company with revenue of 100 million, which is up 55% year over year. They have 22 million of EBITDA and 13 million of net income. This company's financials seem promising to us from a quick glance. At the same time, we know the market doesn't pay as much for a consumer finance company versus a SaaS business. And this may be because of the business model where the consumer finance business isn't guaranteed recurring revenue. So we end up giving this financial set of data a potential range of 2 billion to 7 billion in market cap. In our third example, we have a cosmetics business. And this is an industry we don't typically invest in, so we may have trouble estimating the range here. But we have invested in other consumer-based businesses that sell products, so that may help us here. This cosmetics business has revenue of 600 million, which is up 25% year over year. They have EBITDA of 100 million and net income of 45 million. So this 25% growth rate is a bit lower than we typically look for. But it still may be interesting to learn about what this business is doing. We see the business is profitable, but for a consumer product business, it's not that profitable. And again, we'll give this one a pretty wide range of 4 billion to 16 billion. Additionally, for all these companies, we want to look out what's on the balance sheet, what their gross margin is, and what their product and narrative are saying. We then want to look at the past trend over the year, and geometric accelerations are the best. So we'd ideally like to see revenue, EBITDA, and net income all accelerating. But that's a really rare scenario where we have this no-brainer and we can see from the financials the company is going to do great right away. Probably 99% of the time, we have a much more mixed scenario. Maybe revenue is accelerating, but EBITDA and net income are more flat. With the expected ranges we are creating, if we see a company that's way above the range, we want to find out why the market loves this company so much. Maybe their story or narrative is really incredible, and the high valuation is justified. On the other hand, our take could be that the market is hyping this company too much, or it's getting overvalued now. Likewise, if we see a company that's well below our expected market cap for these financials, we want to find out why the market is so pessimistic. Maybe this is a really good business and it's just undervalued. In that case, we might have a big opportunity. However, one big caution is we want to be really careful if there's been any news about the company recently. Here's an example to show why. The company Sarepta Therapeutics had revenue of 658 million in a previous quarter, and that was up 66% year over year, with EBITDA of 172 million and net income of 159 million. These seem like incredibly strong numbers. The company's growing really fast and they're highly profitable already. So when we see a biotech that's growing this fast and they're profitable, we would expect them to have a high valuation. I might expect this company to be worth 20 or 25 billion. And when we look up what the actual market cap for this company was about a year ago, it was 5 billion. And at first this seemed like it may be an incredible opportunity. But we go back on the stock chart and we see the stock price had a big drop. And we check the news from around that date. The company's main FDA drug was responsible for a tragedy, and there was a potential review process to see if the drug should be pulled from the market now. So there was a very good reason why this company was not valued at 20 or 25 billion, but was instead valued at 5 billion. Their main drug might be pulled from the market. Let's now look at some key takeaways from our discussion on value of growth stocks. Evaluating a growth stock presents some surprising challenges. A multitude of objective and subjective aspects of the business must be taken into account. And we demonstrated 5 ways to measure value in a growth stock. Some of these methods are objective and use cold, hard numbers. But other methods require using the imagination and curiosity to understand the growth story prospects. And over time, we will gain the reps for building our intuition on the value of a growth stock. As we get more experience, the seems like category will play a bigger role in evaluating the value of a growth stock. And it takes practice to get a good sense if a growth stock is undervalued, overvalued, or just fairly valued. And over time, we'll build our skill level and our intuition together. This concludes the video on valuing a growth stock. I'd be really interested in your feedback on what you thought of the concepts in this video. So definitely give me a comment or a like if you enjoyed the video. And as a last reminder, this is not investment advice or recommendations to buy stocks. Thanks.